Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on Sunday, September 3rd, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. Tonight, we delve into FTX's mysterious multi-million-dollar transfers and asks what it means for the platform's future. Then we unpack the emotional confession from the former BitBoy, Ben Armstrong, and the implications for his career in the crypto community. Plus, we explore why Ethereum's co-founder is dumping MakerDAO, how Grayscale is hoarding Ethereum in an intriguing manner, and the absurdity of the UK's crypto inheritance tax. Folks, if you think this FTX story is just about transfers, you're in for a ride. Wait till you hear about the yachts and courtrooms. Hit that subscribe button. You're not going to want to miss this. Bankrupt exchange FTX has been making some eyebrow-raising moves lately. A cold wallet owned by the exchange transferred almost $10 million in altcoins from Solana to Ethereum since August 31st. The altcoins involved include Link, Sushi, Luna, and Wi-Fi. These transfers were conducted via the Wormhole bridge. The reasons behind these transfers remain undisclosed. In another development, a recent filing revealed that FTX's debtors used company funds for internal cash payments to executives and direct transfers to the American Yacht Group. The list includes over $900 million in transfers to Sam Bankman-Fried, labeled simply as cash payment, $15.5 million in cash transfers, and a $3.5 million transfer to ex-Alameda CEO Caroline Ellison. The filing also showed a $2.5 million payout to the American Yacht Group for ex-Alameda co-CEO Sam Trabucco. Now here's what I'm thinking. The movement of $10 million in altcoins from Solana to Ethereum is significant. Solana has been touted as an Ethereum killer, yet here we have FTX moving assets back to Ethereum. What does that tell us about the confidence level in Solana's ecosystem? We're going to be talking more about Solana and Ethereum in a later segment. For now, the $900 million transfer to Sam Bankman-Fried is another red flag. This isn't pocket change, it's nearly $1 billion. It's hard to ignore the distrust this breeds, especially when the Justice Department alleges that Bankman-Fried, quote, misappropriated and embezzled FTX customer deposits. The $2.5 million yacht for Sam Trabucco is the cherry on top. It's a glaring example of how too much power can lead to questionable decisions. Trabucco announced his resignation a few months before the company's collapse. And yet he walks away with the yacht. But just when you thought the financial maze couldn't get more intricate, another key player makes a move that could be a game changer. Robinhood is a platform that's no stranger to making headlines. And here they are, making headlines again. The common thread here? FTX founders in their complex web of financial and legal entanglements. Robinhood's decision to re-enter the scene not only alters the landscape, it adds another layer of complexity to the ongoing saga. Robinhood repurchased a significant stake previously owned by FTX founders Sam Bankman-Fried and Gary Wang. The shares, amounting to $55 million, were initially seized by the U.S. Marshal Service as part of a criminal case against Bankman-Fried. The repurchase cost Robinhood $605 million. The shares were owned through a holding company called Emergent Fidelity Technologies. Wang pled guilty to multiple charges, including wire fraud and conspiracy to commit securities fraud. SBF, on the other hand, continues to plead not guilty to similar charges. The repurchase agreement was approved by the U.S. District Court for the Southern District of New York. Now, let's dig into the implications of this massive repurchase. First off, Robinhood's willingness to spend $605 million to buy back these shares speaks volumes about its aggressive growth plans. But what's even more intriguing is the timing. This move could be seen as a strategic play to distance themselves from the legal entanglements surrounding FTX and its founders. And let's not forget the role of the U.S. government here. The involvement of the Marshal Service in seizing and then selling these shares back to Robinhood could be perceived as the government having too much control over private assets. This is especially concerning for anyone that values financial freedom and is wary of government intervention. Robinhood's $605 million repurchase is more than just a business transaction. It's a complex web of legal, ethical, and financial considerations that could have far-reaching implications for the crypto world. And as always, it's crucial to stay vigilant and question the motives behind such significant moves in the crypto landscape. All that said, there may be something of a silver lining for some people here. As I recall, when FTX tumbled, those Robinhood shares were worth around $585 million, which by my calculations means there's some $20 million in profit here. That money should be going to FTX's creditors. Another $20 million towards making things right. I mean, I hope that money isn't going to the federal government or the Marshal Service. They certainly don't need it more than the creditors do. Ever wonder what happens when the idols of crypto reveal that they've got feet of clay? Ben Armstrong's emotional spill is up next. Like and follow so you're always in the loop. Ben Armstrong, formerly of BitBoy Crypto, released an emotional apology video after being ousted from the company. Armstrong admitted to taking diet pills and steroids, which he claims led to erratic behavior. He also confessed to having an affair. Despite these revelations, his wife Bethany has forgiven him and plans to stay in the relationship. Armstrong expressed his intent to cooperate with the BitBoy crypto team to ensure the channel's continuation. He also emphasized his faith in the various brands under the BitBoy crypto umbrella, such as BitBoy Academy. Armstrong's departures led to questions about his involvement with low-reputation meme coins and risky crypto investments. His digital currency, Ben, has also been the subject of speculation. Armstrong founded BitBoy Crypto and its parent company Hit Network, but parted ways due to an internal conflict with partners TJ Shed and Justin Williams. Armstrong's apology and the drama surrounding his exit from BitBoy Crypto sent ripples across the crypto community, which makes this apology video a pivotal moment that could either revive or ruin Armstrong's career. His admission to substance abuse and marital infidelity certainly tarnished his image. That said, the crypto world is no stranger to controversy. The real issue here is trust. Armstrong's involvement with shady investments and some meme coins raises questions about his credibility. But if you think about it, it's not just about Armstrong. It's about the influence such personalities wield in the crypto space. When influencers like Armstrong promote risky investments, they're playing with the financial futures of their followers. Do you ever notice that I shill no coin, I promote no project? There's a reason for that. The internal conflict leading to Armstrong's exit also exposes the fragility of partnerships in crypto enterprises. It shows even successful collaborations can disintegrate due to personal issues and ethical disagreements. Armstrong's scandal is not just a personal downfall. It's a reflection of the broader issues plaguing the crypto community. It serves as a stark reminder that the crypto world needs to be cautious about who it places its trust in. Armstrong's future actions will be closely watched, not just as a personal redemption arc, but as a measure of the crypto community's tolerance for controversy and ethical lapses. Now, if you thought the trust issues only played to the influencers, brace yourself. Even Ethereum's co-founder is making moves. Vitalik's big sell-off is coming up. Don't forget to hit that notification bell. MakerDAO co-founder Rune Christensen proposed the platform's future blockchain should be built on Solana's codebase. Christensen cited Solana's technical quality and resilience as key factors. MakerDAO is currently undergoing a major overhaul called Endgame, aiming to break the project into smaller sub-DAOs. The final phase of this plan involves rolling out a new blockchain codenamed NewChain to connect these sub-DAOs. This project is expected to take at least 3 years, and some community members have already expressed skepticism, questioning the focus on Solana and Cosmos as the only options. Christensen's endorsement of Solana is a significant nod to the blockchain that has faced challenges, including the collapse of FTX. This move could be a game changer for Solana, which has been looking for ways to regain its footing in the crypto space. But it's not just about Solana, it's about MakerDAO's vision for decentralization. This endgame plan is ambitious, aiming to make the ecosystem more resilient to governance attacks and technical failures. However, the community's pushback raises valid concerns. Why Solana and not an EVM-based rollup? Why the rush to commit to a codebase when the project itself is still in flux? These questions point to a larger issue: the tension between rapid innovation and community consensus in decentralized systems. Then there's Vitalik Buterin, Ethereum's co-founder. He sold his entire MakerDAO stake following Christensen's Solana endorsement. That's right, he dumped his entire stake of 500 Maker tokens, trading them in on 353 Ether, about $580,000. He initially picked up his Maker stake in 2018 when the price was $905. So he saw about 27% in gains on his trade. Now, I don't know that he made a specific announcement about his sale, but this move sends a clear message. Not everyone is on board with this shift. It also raises questions about MakerDAO's future relationship with Ethereum, especially given that DAI, MakerDAO's stablecoin, is Ethereum-based. Are they going to shift that to Solana as well? MakerDAO's potential shift to Solana's codebase could redefine the project's future and the broader DeFi landscape. But it's a move fraught with risks and disagreements, highlighting the challenges that even the most established projects face in this rapidly evolving space. Now, if you're feeling the lack of trust, you're not alone. Grayscale's Ethereum hoarding is next. Transparency? Maybe not. Hit the like button if you value clarity. Arkham Intelligence identified over 500 wallet addresses tied to the Grayscale Ethereum Trust. The trust is the second largest ETH entity globally, with holdings of $5 billion according to Arkham. These wallets do not hold more than $30 million in assets each, making the identification process challenging. Arkham was able to identify these addresses by analyzing activity and cross-referencing with Grayscale's publicly reported balances. In total, Grayscale holds nearly 3 billion Ether. Arkham also reported that Grayscale Ethereum Trust holds 3,590 Bitcoin worth $92.7 million. The trust was first formed in December 2017 and provides passive exposure to the price of Ether. The trust experienced a 60% discount at the beginning of 2023, which has recently lessened to 30%. Arkham's findings are a revelation for the crypto community. Grayscale's Ethereum Trust is a behemoth in the Ethereum market. With nearly 3 billion Ether and 5 billion in holdings, it's a force to be reckoned with. But let's not overlook the 3,590 Bitcoin they also hold. That's another $92.7 million in assets. The fact that these wallets don't hold more than $30 million each is intriguing. This could be designed to make it harder for entities like Arkham to identify them. This level of obfuscation raises questions about transparency. Is there a reason to hide their balances? Is this just done out of an abundance of caution, or are there other machinations at work? The trust's discount rate also tells a story. It dropped from 60% to 30% this year. That is a significant change, and could indicate a shift in investor sentiment. Are people starting to trust Grayscale more, or is this just market dynamics at play? Arkham's report is a wake-up call. It's a reminder that as much as we love the idea of decentralization, big players like Grayscale still hold significant sway. They're not just participants, they're market makers. That's something to think long and hard about. When big players play games, who pays the price? Sometimes it's the little guy. Especially if you're in the UK. Their crypto tax mess is up next. Subscribe for the inside scoop. In the United Kingdom, families inheriting cryptocurrency are facing a significant issue. Financial Conduct Authority data reveals that about 10% of people in the UK own cryptocurrency. Yay! Ownership doubled between 2021 and 2022. Globally, around £23.7 million are lost each day as crypto investors die without passing on keys to those wallets. This leaves the value of cryptocurrency unreachable. Despite this, the UK government still imposes inheritance tax on these digital assets. The tax-free threshold for each person is £325,000. Above this, a 40% charge is applied. An estate worth £100,000 worth of inaccessible cryptocurrency could still be liable for $40,000 in inheritance tax. Experts like Paul Rossini, founder of AssetPass, and Christopher Thorpe, a technical officer at the Chartered Institute of Tax, criticized the UK's approach, stating that the government is simply not equipped for cryptocurrency taxation. So imagine you're a family member who just lost a loved one. You find out that they have a significant amount of cryptocurrency. But there's a catch. You can't access it because the keys are lost. You would think that the government would have some common sense here, right? Wrong. The UK government is essentially saying, we don't care if you can't access it. You still owe us tax money. That's just not fair. In fact, I'd say it's flat out predatory. It's like taxing someone for a treasure chest they can't open. The government's lack of preparedness for the digital age is glaringly evident here. They're applying archaic tax laws to a new age asset class without any thought for the real world implications. And let's not forget, this isn't just a UK problem. Crypto is global. If one government can get away with this kind of financial absurdity, what's stopping the others? This shows just how important it is to have a plan for your digital assets, especially in a world where governments are more than willing to capitalize on your misfortune. The UK's approach to crypto taxation is a glaring example of how out of touch and ill-equipped governments are when it comes to this new digital economy. This is a glaring symptom of a system that's failing to adapt, and it's the average citizen who's paying the price. So what happened? FTX transferred a stunning $10 million in altcoins while its executives took in large cash payments. We also saw some 55 million Hood shares returned to Robinhood by way of a sale from the US Marshals Service. Ben Armstrong, formerly of BitBoy Crypto, made an emotional public apology after being ousted for multiple reasons, including substance abuse and infidelity. The revelations have cast a shadow on his brand and raised questions about influencer credibility in crypto. MakerDAO co-founder Rune Christensen has endorsed Solana as the future blockchain for the platform. However, this move was not universally applauded. with Ethereum's Vitalik Buterin selling his entire MakerDAO stake, possibly as a sign of disapproval. Grayscale's Ethereum Trust, a behemoth in the ETH market, has been further unveiled by Arkham Intelligence. The trust holds almost 3 billion Ether and manages to keep its operations opaque, raising questions about transparency and large-scale crypto investments. Finally, the UK government is imposing an inheritance tax on inaccessible crypto assets. This move is being criticized as not only absurd, but predatory, highlighting the disconnect between government regulations and the realities of digital assets. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.